this section is going to be fully focused on the reverse charge mechanism. Now, the best way to understand what exactly reverse charge is to find out how it is different from the normal situation. You'll get the nuances of what exactly reverse charge is in this manner. And so, let's first check out what usually happens in absence of reverse charge. That's the normal situation. Here's a bird's eye view of the normal situation. Let's check the steps one by one. First step, of course, there's a purchase of goods. Our business would purchase goods from the supplier. So the wholesaler sells goods to business. On this purchase, the business would incur tax expense. That's the input tax on purchases. Now the wholesaler will collect this tax amount from the business along with the purchase cost. This is step 2. Third step would be where the wholesaler will pay this collected tax to the government. It is the wholesaler's liability to pay tax collected from its customers to the government. Next step is between the business and its final consumer. Of course, there's a sale of goods. The business would sell goods to the final consumer. In return for this sale, the business will collect tax along with the price of the product from the customer. Now, it's the business's responsibility to pay this output tax, the tax collected from customers' output tax, to the government. And as you would have already guessed, here's where the business would utilize its input tax credit. It needs to pay only net tax to the government, output tax minus input tax. So after deducting the tax on supply, the remaining the business will pay to the government. So this is the usual case. The wholesaler sells goods to business. Wholesaler collects tax from business. Wholesaler remits this collected tax to government. Business collects tax on sales from its final consumer. It pays the output tax to the government after deducting input tax paid on supply. This is how the normal tax flow, cash flow related to taxes works in normal situation. What happens during reverse charge? Let's check up. Now here's a bird's eye view. The first step would definitely remain the same. The wholesaler sells goods to business. Second step is where there's a change. The wholesaler will not collect tax from the business on its sale under reverse charge mechanism. But the business will have to incur tax expense on its purchases. How would this work? The business will have to calculate the tax computation on its purchases, and it is the business's responsibility to pay this tax to the government. Earlier, it was the wholesaler's responsibility to collect tax from the business and pay it to the government. In this case, it is the business's responsibility to directly pay to the government. The tax expense still remains with the business, but the liability to pay is also now on the business. This precisely is reverse charge, because now the liability has reversed. It's no longer on the wholesaler, it is on the business to pay to the government, and that's why this exactly is called the reverse charge. The business will have to pay this tax directly in cash to the government. Now in the next stage, where the business sells goods to customer and collects tax from the customer, in this stage, for paying output tax to the government, the business can set off the reverse charge paid. That is, the business can claim input tax credit on the reverse charge actually paid. So usually, in the absence of reverse charge, the seller would collect tax from the buyer. Buyer obviously will have to pay tax to the seller. It is the seller's liability to remit this tax to the government. The tax expense is still on the buyer because buyer has paid this tax to the seller. The seller can claim input tax credit to pay this tax collected from the seller to the government. Under reverse charge, what changes is the liability to pay tax to the government. The seller will not collect any tax from the buyer. It is the buyer's liability to remit tax to the government. The tax expense is still for the buyer.